This is a 1 month program and you are in the 3rd week's first day program. So post this week also we have one more week of program. So today first day program you will be learning about Elliott wave principle. Tomorrow you will be learning on Gann square of 9 and 12 principle. Day after tomorrow you will be learning how Fibonacci and volatility will be utilized for intraday trade. Followed with 15th October you will be learning on how you can utilize Gann angle principle for intraday trade. And the end of this week you will be learning on the option price model and implied volatility. So these are the programs scheduled for this week. So and followed 4th week also we have the programs on arbitrage trade, delta neutral strategy, pair trade. Many interesting things is there. So if you have not registered for the 4th week program, please register for the program event. And today's session on how Elliott wave study will do and how we can utilize the concept of Elliott wave in our analysis. So that will be the today's topic. And this particular concept of Elliott study is very essential, and many used to say it is very critical and very difficult study for implementing in the technical analysis or for implementing in the trade. But I think it is one of the easiest study. Only thing is that little bit of concentration you require. So what this study says, why it is different from other studies, and how we can utilize this Elliott's principle for our trade benefit. These are the things we are going to learn. So the foundation of this particular study of Elliott wave stands on two approach. One is price of any financial instrument. That instrument must be a stock, index or commodity. Start with the cycle. So I will be telling the definition of a cycle as per the financial arithmetic. And second part of the study says that every price action in a cycle is harmonic in nature. This term harmonic also I will explain in detail. So whenever we talk about the cycle, or if you are utilizing our software, you will be knowing that we have given trend as per the first cycle, second cycle and third cycle. Cycle means once one trend started, that trend should have a starting point. Then the trend will give you a confirmation point. So one will be the starting point of a trade, then it will be a confirmation point of a trend, and then it will be a mature point of the trend. So once this trend matures, then whether the same trend will continue or the trend will reverse. Out of these two possibility, any one possibility will work. So if the same trend is going to continue, then from where the second trend will start, or the second cycle trend will start, when it will give confirmation and when it will mature. So these are the process. The cycle is nothing but the starting of a trend and ending of a trend. So this starting and ending of a particular trend is known as a cycle. So based on this particular concept of cycle, all dynamic analysis or all dynamic theory of stock price analysis is standing. So all the dynamic concept, whenever you will see, this stands on this cycle concept. So as I said to you earlier, if moving average crossover happens, then when this moving average crossover will again enter to the opposite direction. Means if you are saying 5 period moving average crossed the 10 period moving average, so this is a crossover happened and the trend is up. So at what price point this same 5 period moving average will be below the 10 period moving average. So the price point X where the 5 period moving average will below the 10 period moving average is not known as your trend maturation point or the end of this particular trend. So from the price point where the crossover happened and price point where the crossover ends is known as your cycle. Then second part is saying that every price action in a cycle is harmonic in nature. So whenever we investigate in this term of harmonic, many of us will be knowing that harmonic is a concept wherein we revisit the same point, same price point or same energy point again and again. That is known as your harmonic. Suppose if you take the case of a simple pendulum clock. So this pendulum clock, we used to say it moves in a simple harmonic motion. So if you are a student of physics, you will be knowing that. Means as long as that energy is there, this clock will move from one point, then it will move to the mean position, then again it will move to the opposite position. So this movement will be going on as long as this energy is there. That energy may be a battery energy or the keying energy. So this nature of movement of a pendulum clock is known as your simple harmonic motion. Means the point from where we have started, same point we will be revisiting again and again. So in the same definition, if you replicate here, this says that the low what you have created now, you may revisit that again. The high which is being created in the past, you may revisit it again. Same time, it is not ruled out also that you will not make a new high or you will not make a new low. So the new low and the new high is always a possibility in the financial instrument. Same time, the new high and the new low which is already made in the past occasions is going to happen in future in some or other time. Only the situation and circumstance will be different. However, it is always a possibility. That's why the price action is in a cycle is harmonic in nature. So it also has a very broad classification. Those broad classification, I have just told you the definition point of view, this harmonic nature. This broad classification of the cyclic and harmonic nature of a price action is well interpreted by the Elliot. So he has told every impulse, this harmonic nature of a price movement can be categorically divided into two groups. One is impulsive and another is corrective. Impulsive means more energy, more demand or more supply. Corrective means less energy, less demand and less supply. So often traders think that impulsive means it is only going up and corrective means it will be falling down, because we have derived or we always translate the terms corrective means it is a correction, market correction. It is not like that. Impulsive means more energy, more demand or more supply. Corrective means less energy, less demand or less supply. So this is how the corrective and impulsive is being categorized. Then impulsive is being categorized into 5 different subwaves, and Elliot was gracious enough, he has not given a complex name, he has given 1, 2, 3, 4, 5. Very easy to understand and remember those names. Then also he has given A, B, C. Very easy to understand and remember these names. And whenever these actions takes place, the upward impulsive action or the downward impulsive action takes place, these actions will be having a wave 1, then followed with wave 2, then followed with wave 3, followed with wave 4 and wave 5. So out of this impulsive wave pattern, wave 5 is the longest wave, and whenever it is happening in a downward trajectory also, same way the wave 3 is the longest wave. And similar way we have the ABC pattern. So wave A, wave B and wave C, it may happen in the upward direction or it may happen in the downward direction. So whenever the ABC happened in the upward direction, it will be tilting upward. Whenever the ABC happen in the downward direction, it will be hitting in the downward directions. Besides this, Elliot also has given many patterns. 13 wave patterns he has given. 1, 3. Ending diagonal, leading diagonal, all LD, ED patterns, channels. So zigzag pattern, channels or channeling in this pattern. So many 13 different patterns also Elliot has given. So while studying this particular Elliott wave structure, we have two different approaches to study. One is wave construction approach, another is the wave count approach. So whenever we talk about the wave construction approach, we construct the ABC wave or 1, 2, 3, 4, 5 wave, and we used to say that yes, this wave has ended and the next wave is going to start. When we are going for wave count approach, so in that case what used to happen, we used to count. So these are the patterns has formed, has already formed, and this is going to form. So based on that also wave construction and wave count approach are there. Wave count approach is little difficult to practice. You need the help of a sophisticated software which can do your drawing of these waves and help you for counting certain things. However, whenever you are going for a wave construction approach, it is easier. So in wave construction approach, which I am going to explain to you, here what happened, wherever we take one reference price point, from there, whatever the previous trend is there, one price range we will be deriving. The prior swings price range we will derive. That range 0.382 retracement is known as your wave 1. And if you look into the structure of a wave, so here in 1, 2, 3, 4, 5 wave, 3 waves are the rising wave and 2 waves are the corrective wave, or the 3 waves are the upward journey wave and 2 waves are the downward journey wave. So first wave 1 is a upward journey and wave 2 is in the counter leg of the journey. So this is wave 2, and wave 3 again it is a upward journey, and wave 4 is a counter journey, and wave 5 is a upward journey. So wave 1 in the impulsive cycle will be 0.382 retracement of the prior swing. Wave 2 is 0.618 retracement of the wave 1, and wave 3 is 1.236 retracement. So here this wave 3 is 1.236 retracement level. So these are all Fibonacci ratios, and it has an expansion of first degree, expansion of second degree. Wave 4 again in against the counter trend, and it is 0.618 retracement of wave 3, and wave 5 also having same length as wave 1, and it has an expansion of 1.618 retracement of the wave 1, and it too also have second degree of expansion till 1.618. So these are the things of a wave structure, and it has a vast rule also. This wave 3, if wave 3 is a expansion, wave 5 also is going to become an expansion. Similar way, if wave 3 should not take more than 3 times the time taken by the wave 1. So similar way, many rules is being implemented to enhance the accuracy level of these waves. So all these wave rules is the personal experience of Elliot. It is the personal research work of Elliot, which nobody has given any contradictory talk on that. So everybody has accepted those rules as it is. So same thing once we are going to do, and here one small changes only we have brought. Instead of deriving the high and low difference and from there which is the prior trends price range and deriving all this wave structure, we can do it dynamically also with the introduction of the volatility. So here I have given one example. Suppose if you are saying that today Nifty high was 8247 and low was 8150, if this is the thing you have achieved, and if you are going to rising impulsive wave, if you are going to draw, then you have to start with from a low 8150 and it will be ending at 8182. First wave will make some price difference, and from that price difference you have to draw the second wave, and second wave is again going to generate the third wave, and third wave will go for a expansion. If it goes beyond 8200 till 8212, then you can say it is an expansion of first degree. Suppose in third wave, how you will understand that it is going for an expansion? So from 8162, if the price move to 8200 and did not correct from that level and again further move to 8212, then you can say that it has gone for a first degree expansion. Then second degree expansion will be till 8224. So if it further doesn't correct from this level of wave 3, then you can say that it may be forming a ABC pattern. It is not going to form a 1 2 3 4 5 pattern. So if it corrects, wave 4 forms, completes, then we can say that wave 5 also will form and wave 5 will take us to a different level. So wave 3, if it is an expansion, then wave 5 also will be a expansion. So here these waves, whenever you are constructing this wave, you are not counting these waves, rather you are constructing the waves. Whenever you are constructing the waves, some timing protocol also you have to follow. Wave 1 and wave 5 normally used to complete in the same time period. Wave 2 used to take 2/3 of the time taken by the wave 1 completion. Wave 3, because it is a high energy wave, wave 3 normally takes less than the 3 times of the time taken by the wave 1, and wave 4 also takes maximum 2/3 of the time taken by the wave 3. So this is how the timing protocol of this wave 1 2 3 4 rising impulsive waves structure works out. Similar way you have a falling wave structure ABC, and that too also having specific rules, and that too also having specific starting point. But this static method of drawing the waves from a low till a high or from a high towards a low never produce a great accuracy or great result, this wave construction approach. So what we have to do here, we have to change this particular concepts to a dynamic concept. So what is the dynamic concept of this particular wave arithmetic? So the price range what we are deriving from this high and low difference, we have to derive it from a volatility. So, and we have to take the price reference either from a close or from a current price or from a opening price. So imagine, so suppose if we are going to draw the wave structure for tomorrow for the Nifty, so this is how we have to calculate that. Now I have to investigate upon. So 8154 I closed, and 1.17 is the daily volatility. So 1.17 is the daily volatility. 8154 I have closed. So this is the price range I am expecting for tomorrow. If I am starting my calculations from here, 8154 till 8190, my first wave will be ended. Then my second wave should give some corrective action. Post 8190, I should expect a correction till 8167. Post that, I should rise. So this is my expectation. On wave 1, wave 2, wave 3, wave 4 and wave 5 should move in this particular price range. But this is not necessary that price will move in this order. This is I am expecting based on a calculation. So this calculation I should not say that Nifty, since I have calculated, you accept this and move in this particular order. So here we have to see some fine tuning of this thing. If this wave 1, which was expected to complete at 8190, post 8190 does not invite any major correction till 8167, does not invite any correction. After touching this one, it has not fallen to 8168. Then I will say that this wave 1 is expanding to a different Fibonacci ratio. Means from 8154 it has not gone to 8190, but it has not fallen from there till 816. So wave 2 has not started. It has gone beyond that. Say it is going to 8200 plus, then only it is started correcting. So then I can say that it is the longest wave 1 has happened and it has followed a particular Fibonacci proportion. It has followed a proper Fibonacci proportion or Fibonacci ratio. So the ratio which it has followed for wave 1, the wave 5 will follow the same ratio. This point is very important. First, initially we have taken wave 1 will follow 0.382 retracement and it has not followed that, it has moved beyond that and it has gone to say 0.786 retracement or 618 retracement without slipping from here. So what we will be considering here, the wave 1 which was expected to complete a minor wave with smaller Fibonacci ratio and followed a greater Fibonacci ratio. Henceforth wave 5 also will form a greater Fibonacci ratio. Once that is followed the higher ratio, say it is falling 0.786 ratio it has followed, then or 1.236, imagine it has straight away rise or gap up opening has happened, it has straight away rise to a level of 81502 8212. So it has followed the 1.236 retracement for completing wave 1 from 8154. Then my wave B or wave 2 will be the lowest ratio as compared to this one. So the ratio which is coming and the wave 3 now, sorry, wave 2 now should not be 0.618, it should be 1. So previously it was 1. Previously we have expected at 0.382, it has gone to 1.236. Henceforth the lowest ratio, the ratio which followed before this one, should be considered for the wave 2. Somewhere it has to start the correction. So that point it has to be taken, and the just before that ratio which is there, the nearest lowest ratio following this wave 1 should be your wave 2. And from there, once you are starting, suppose it is 1 you are taking. So 2 steps ahead. So your wave 3 will not be 1.236, rather from 1 it has gone to 1.618 and its expansion will happen to 2 and 2.236. So this ratio will be taken for the wave 3. And wave 4 also will follow the same protocol, and wave 5, whatever the ratio followed by wave 1, same wave will be followed by the same ratio will be followed by the wave 5. So this dynamism also exists in the Elliott wave theory. That's why we used to say there is a gap has formed, and once this gap is breached or once this gap is again created, so we will have a deeper correction or a big rally. So whatever we talk about in the gap, same concept is being talked in the Elliott wave study in a more accurate and more precise manner. So the ratios which is involved in this wave 1, 2, 3, 4, 5 is not constant. It changes dynamically based on the situation, based on the trend termination point. So that is the major difference in this particular wave study, because it is a wave, it will never end. So it is just like you have to see that if you throw one stone in a still water, so it form a wave, then that wave generates a higher wave, that wave generates a bigger higher wave, so this continues. But that doesn't mean that lower wave has ended here and there is no wave. Once this wave expands and goes to a higher wave, same time also one more smaller wave of the same size creates, and this again propagates to the new wave, and this tendency continue as long as the energy on the stone is preserved and energy transmit from one particle to other. So same concept here. It says that whenever any demand or supply situation is being created, that situation creates smaller or bigger waves, and that smaller and bigger actions used to replicate till the till that particular situation persists. So that is what the wave theory is. Similar order, you can have a wave ABC or the corrective wave or the low energy wave, where wave A is 0.618 retracement of the prior wave, wave B is 0.618 retracement of wave A and expand till 1.236. So expand till 1.236. So 236 retracement of the wave A, and wave C is either 1.618 or 2.618 of the wave A. So these are the very basic rules of your things. So here, after constructing this wave, what are the other things you require? You require to identify a trend. You require to enter a buy sell trade wherever you want. Then you need where these patterns are going to change, and I will book a profit and come out. So in impulsive cycle, whether it is rising impulse or falling impulse, wave 3 starting point or wave 4 ending point is the best point where you can enter a trade, buy or sell trade. And once this you have made an entry at wave 3, you have an expectation, yes, wave 3 will go to such and such level, but it has failed to achieve 68% of that. Then you will say that this wave structure is going to fail. So also you have to understand a concept in the wave theory says that wave failure or the wave structure also used to fail. So if whatever estimations you have made, if out of that estimation 68% of estimation you have not achieved, then this is going to a failure or a complex correction. So second point also, if it achieves only 38% of this thing targeted journey, then you can say that it is not going to form any kind of ABC wave or 1, 2, 3, 4, 5 wave. Rather, it is going to form wave of equal lengths. So wave of equal length means it is going to form a pattern like this. Same wave, same equal length waves it is going to form. If 0.68% of the targeted thing it is not achieving, then it is a failure. If it is achieving less than 38% of your targeted journey, then you can consider that things as a not a wave, that rather can be translated as a zigzag pattern, wherein you can say that it is going to form a equal wave of equal length. So it is not at all considered as a Elliott wave study. Rather, we can say that it is waiting for specific news or outcomes to influence itself. So this is what how you can invest in a stock using Elliott wave study. So here it's a very simple processes I have given. Watch out for a major low or high in a period which matches your holding period. Suppose if you are going for a 1 month period, 3 months period, 2 months period, 15 days period, during your 1 month period of holding if you want to buy any stock. So for during that 1 month, what is the low and high it has made? So draw both impulsive and corrective wave, impulsive rising and corrective rising, impulsive corrective impulsive rising and corrective rising means 1 2 3 4 5 in the rising direction, ABC in the rising direction, 1 2 3 4 5 in the falling direction as well as ABC in the falling direction. Watch out for a correction or complex correction rule means price moved, it has not completed that things means 100% of your estimation it has fallen back. So if such kind of correction or complex correction you are finding out, that is a point you should invest. So you should invest. So then only you can say that if you invest on that, so you can say whenever there is a complex correction happens, means you have calculated wave 3 is going to give me for 50 points of gain, but out of this 50 point only 60% means 30 point gain it has given and from there it has fallen. So it is not considered as a wave 3 means it is a failure. So it is a complex correction has happened. Then or it has just given you 20 points, 28 points and never moved beyond that. So you can say that is complex correction intact. So that time you should initiate. Whenever it is a complex correction or correction happens, then the next wave should be a bigger wave in the direction of the trend, and which can reward you better. So this is also a rule as per the Elliott study. So Elliott study, we can, as far as whatever I have told you, it is a combination of Fibonacci principle which creates the wave. Again, it has a set of rules set by the Elliott which must be followed, and it has a dynamism of implementing those Fibonacci ratios into it, and it has a dynamism to add volatility component into its study. So those who are having the book on technical analysis book volume 3 of our organization, there most important rules of this wave structure I have given along with some important patterns. If you have, just go through that, and some of the rules once you read through it, many of the rules you can able to remember and you can able to implement that things. So those who are the member of this smart finance community or those who are with us and those who have registered here, you will be knowing that every month we used to conduct some webinars, 2 to 3, and this time it is going for a 1 month period, and many tools and other things you are getting 2 to 3 times in a month. You are getting the newsletters. So if you want, or you want your friends to register, please invite them to register in this register link so they can get those benefits whatever we are giving. So every weekend we are releasing the newsletter on Nifty future movement. Every time we are conducting specific events, so you can ask them for this. So before going for your question and answer, so have a look on our products and services. Normally all our products are academic or software related products. So the concept what you have learned today, it is under the third product Elliott wave course, wherein you are getting 3 DVDs explaining various Elliott wave concept, one book which has a vast explanation of the Elliott wave principles. And we have a wave construction small calculator available in our website which you can utilize. Also we have given a small ebook on Elliott study on our free ebook in our website. You can download it. So this courses is being designed with the Indian stock examples, Indian market examples, and it is for the Indian traders. So by taking your known stocks. So same concept is being programmed in our softwares also. In our software also you have a Elliott study which added all these studies and encapsulated into the wave structures and other things. So these things if you want to buy separately it costs around 47,000. Those who are wants to learn completely, so they can buy the entire package wherein we used to give a good discount 17,500. And this is our sales number 984034891. You can look into that. And our softwares also, those who are having the smart IT software, they are having a Elliott study also. So you can say once you are going for our integrated tool software, smart IT software, so there also we have given Elliott study. So we have also added the cycle concept into that. So any instrument of your like, you can just choose equity, future, index future, anything. Then you have to just hit a button. Then you have to go for the Elliott study. You want to see the impulsive cycle or corrective cycle. So this will say you in this, and once you go to the summary, you will be getting the details, how many studies are suggesting you to buy, how many are for sale, and each cycle what the cycle says, where the price is, when, whether you should buy or sell. All these things you can do, and whenever you will be choosing a positional, you have to give number of days which you are wish to retain the position. So based on that the calculations will be done as per the Elliott study, and you can get those details also. So this is about the product. Small correction is there. It is 61.8%. So as for the Fibonacci only it is being taken. It is asking how to difference between a 1, 2, 3, 4 wave, 5 wave and ABC wave. As I told you, whenever this wave 1 construct, that is no guarantee that 0.382 retracement ending it should start correcting, it may expand. So similar way, wave 2 is a counter wave of the wave 1 and it should come till 0.618. But if this wave 2 is an expansion going to 0.786 level and expand further 0.786 level and expand further, and once it goes to 1.236 level of your expansion of this wave 1 suppose if it is given you 30 points and wave 2 is correcting till 1.236 retracement level, then you can say it is a ABC formation is going to take place after having a complex correction. So it should be considered as a ABC formation. So by looking at the wave formations, looking at their disobedience to this particular Fibonacci proportions, you can able to know whether it is going to be a impulsive wave or a corrective wave. Example what I have taken here, I have used the Nifty volatility as 1.17 daily. So 1.17 multiplied with square root of 365. If you take this one, so this is your annual volatility. So 22% of annual volatility. Here's the levels calculated by the Elliott wave principle may not give you more success because it may invite the complex correction or it may invite a failure. Failure means you have calculated one wave will give you 10 point, maybe it is a wave 1 2 3 A B C anything, but only 60% of that target has achieved. You have calculated wave 2 will fall from 8190 to 8167, but so it will give you near about some 30 points, but out of 30 points only 9 or 7 points it has fallen and moved up. So that you can say that it is a wave failure. Whenever 60% less than it is 61% lesser it is achieving and reversing from there, it will consider as a failure. and as if the 38% and lesser, you can say you are in a complex correction of this wave. Complex correction is not in terms of price correction. Complex correction means it is not going to complete the effect.